I mean, the average person assumes that closing an old, unused credit card from college is the financially responsible thing to do. You are eliminating a potential avenue for debt, so you just naturally assume the bank will view you as less risky.
Here's where it gets really interesting. Treating your credit score like a single test grade, where you just delete the bad or unused parts, is the wrong approach entirely. It's actually more like a physical fitness tracker.
Oh, I like where you're going with this.
Yeah, closing an old credit card is like deleting your first 5 years of workout data from the app. The system doesn't see you as someone who has been responsibly maintaining their fitness for years. The system thinks you just got off the couch yesterday.
That is a fantastic way to visualize it. And if we connect this to the bigger picture and look at the underlying math, closing that old account triggers two negative mechanisms simultaneously.
Okay, what's the first one?
First, as your fitness tracker analogy highlights, you wipe away the length of credit history, which, remember, is a 15% slice of the FICO pie.
Right.
The algorithm calculates the average age of all your open accounts. By closing your oldest account, your average credit age just plummets. You suddenly look like a much newer, less experienced borrower.
Wow. And what's the second negative mechanism?
It alters your credit utilization ratio.
Okay, break that down for us.
Sure. This is the mathematical relationship between the debt you have and the credit you have available.
Right.
Let's say you have 2 credit cards, each with a $5,000 limit. That is $10,000 of total available credit.
Got it.
If you have a $1,000 balance on one card, your utilization ratio is 10%. That's a very healthy ratio.
Makes sense.
But if you close the unused card to be, responsible, your total available credit drops to $5,000.
Oh, no.
Yeah. That exact same $1,000 balance now represents 20% utilization. You didn't send a single penny more, but mathematically, you suddenly look twice as reliant on your available debt.
And the algorithm flags that?
The algorithm flags that as increased risk, and your score drops.
That is wildly counterintuitive, but I mean, the math makes perfect sense once you break it down like that.
Exactly.
And the deck emphasizes the time cost of making these mistakes. Every single month you spend trapped with a suboptimal score because you made a well-intentioned error is a month of potentially higher payments or delayed home ownership. You are quite literally paying for your own guesswork.
Which is why strategy must absolutely precede action when dealing with these financial algorithms.
Right.
You cannot rely on human common sense because the algorithms don't operate on common sense.
Yeah.
They operate on hard mathematical logic based on massive data sets.
Right. They're not humans.
No,
Yeah.
they're looking for specific ratios and timelines that just do not align with our emotional understanding of what good financial hygiene looks like.
So we have this massive problem where trying to fix your credit blindly actually breaks it. I mean, it's like trying to fix a computer by randomly unplugging wires. It might seem like you're doing something helpful, but you're probably just crashing the system.
That's a perfect analogy.
So if human intuition is failing here, and the algorithms are only getting more complex with the shift to VantageScore 4.0, lenders and borrowers must be relying on something else to parse this data safely. And this is where Lynk Financial introduces their technological solution.
Right. Because telling someone not to guess isn't actually helpful unless you provide them with the exact answers.
True.
That is where Lynk Financial's integration of CreditXpert into their origination process really changes the landscape.
And just to clarify for everyone listening, when we talk about the origination process, we mean the entire timeline and procedure of creating a new loan, right?
Yes.
From the moment you apply through the underwriting all the way to the final funding of the mortgage.
Exactly. The whole journey.
So the presentation describes CreditXpert as a predictive AI engine built specifically to help mortgage borrowers reach their maximum scoring potential. And the mechanism behind it is fascinating.
It really is.
It actively scans your credit reports across all 3 bureaus and uses machine learning to essentially reverse engineer the scoring models. It knows exactly how FICO and VantageScore weight different variables.
Right.
So it can pinpoint the exact areas where your specific financial actions will have the greatest mathematical impact.
It acts as an algorithmic counterpart to the credit bureaus. Because it understands the scoring model's rule books perfectly, it doesn't just look at your data and offer general financial advice.
Right. No generic tips.
No, it identifies the specific levers you need to pull to manipulate the outcome in your favor.
The exactitude of the system is what really stands out to me. It provides customized action plans. It doesn't hand you a vague directive like, oh, you should really pay down your revolving debt.
And just quickly, by revolving debt, we mean credit lines where the balance carries over month to month, like a credit card, as opposed to an installment loan, like a car payment.
Right. Thank you. So instead of that vague advice, the AI gives you specific steps down to the exact dollar amount.
Which is amazing.
It might tell you, pay exactly $412 to this specific Visa card, pay $0 to your MasterCard, and do not close any accounts.
Wow.
It completely eliminates the guesswork. You are just executing a mathematical recipe.
And that precision is so necessary because, as we established earlier with the utilization ratio, overpaying a certain account might yield diminishing returns.
Right.
While allocating those same dollars to a different account might cross a specific algorithmic threshold that triggers, like, a 10-point score increase.
Oh, that makes a ton of sense.
Furthermore, CreditXpert features a score simulator tool. So before you allocate a single dollar toward paying down debt, the AI can model how different potential score levels will directly impact your mortgage rate.
And your monthly payment, too.
Yes, and the total lifetime cost of your loan.
So you essentially get to preview your financial future before you even apply for the mortgage.
Exactly.
The presentation states that 73% of applicants who follow this AI-driven action plan see a 20-plus point increase in their credit score within just 30 days.
That's incredibly fast.
It is. And when you connect that back to our earlier math, where a 40-point jump saved $108,000, a 20-point jump in a single month is just an incredibly efficient use of capital. You aren't just hoping for a good outcome. You are mathematically engineering one.
And this raises an important question because that capability forces a profound shift in the power dynamics of the modern lending landscape.
How so?
Well, for decades, borrowers have been entirely passive subjects in the credit check process. You submitted your application, a distant computer judged your history, and you just had to accept whatever fate the algorithm handed down.
Yeah, you had no control.
Right. But with predictive AI tools running simulations on the front end, borrowers are no longer passive. They can actively simulate, predict, and engineer their financial profiles to satisfy the exact criteria the lender's algorithms are looking for.
It levels the playing field between the institution and the individual.
It really does.
So what does this all mean for you, the listener? Taking all of this source material into account, the old way of doing things, just crossing your fingers and hoping your score is good enough when the bank runs your file, is fundamentally obsolete.
Obsolete and expensive.
Definitely. Lynk Financial lays out a really clear 3-step approach to taking control of this process. Step 1 is review your credit profile. You pull your reports and run the AI analysis to see exactly where you stand against the algorithms.
Right.
Step 2 is build your strategic plan. You let the AI map out the fastest, most cost-effective path to your target score, executing it down to the exact dollar amount.
No more guessing.
Exactly. And step 3 is achieve your goals. You secure the best available terms and unlock that dream home without paying an invisible 6-figure tax to the bank.
It redefines the role of a mortgage consultant, honestly. They transition from being someone who merely, finds you a loan product into a strategist who helps you mathematically earn the best possible loan terms.
The presentation ends with a quote that perfectly encapsulates the urgency of this topic. It says, "The best time to start improving your credit was yesterday. The second best time is today."
Very true.
And if you want to start that process and see what these AI tools can do for your specific profile, you can reach out to Lynk Financial directly. Their number is 248-889-2401, or you can find them online at www.linkfinancial.com.